Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, starting a fresh new week. And it's not a bad-looking screen if you look at world markets. And it looks like global bulls are everywhere. Stocks, currencies, commodities, even Bitcoin for that matter. Will some of that rub off here in India is the question, which we will start talking about here in just a bit. This is Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, morning, folks. So back after the weekend, and hopefully the bulls will want to, retain control, keep building on some of that ground. But you know what? It's women on top in global markets today because the new Japanese Prime Minister, first time ever, I think the country's gotten a woman leader, and Miss Takaichi. I mean, her presence is leading to a 4% rally in Japan. So that's a big global headline.
Well, that's right. And the Indian markets at least found their form towards the end of the week. So let's hope we continue with that sort of form.
Absolutely. And actually, it's pretty a good-looking screen overall with markets, financial markets and all kinds of markets doing very well. As I said, I mean, I was looking at Bitcoin over the weekend, look at gold this morning. You, of course, look at, the unloved, under-owned equities in Europe. Forget about US, which has been doing well anyway. So it's really, it's a global bull market. Even actually for emerging markets as a pack, I'm not talking about the Asia ex-Japan pack, which we normally sort of associate and sort of put India into. But if you look at the broader EM basket, this has actually been one of the great runs going back the last 15, 20 years or so. So that's where we're at. Now, no signs of course, U.S. shutdown relief. That was the big story from last week carrying into this week and out of the U.S. So no jobs report as well. And that was supposed to be the big data point as we sort of started this week for global markets, etc. And that's had an outsized impact one way or the other, but no data because the U.S. government's shut down. So Friday, in terms of equities, it was directionless. S&P was up a little bit. NASDAQ was down a little bit. You had ISM services data. So there is a bit of mixed commentary here. The headline number is above 50, which means it's still in expansionary territory. But the business activity printed the lowest since 2020. Anyway, I mean, I think if you look at yields, dollar, etc., not very much by way of a move. Now, the market in Japan, the Nikkei, which anyway has been rallying hard and strong, another 4% higher. Madam Takaichi is set to be Japan's first female prime minister. She, her policies, and if you read about her, what she said in speeches, etc., is not very drastically different from other candidates, but maybe at the margin a little bit. She's okay with the bond issuance, the unending bond issuance program in Japan. Little more than others, maybe a little more expansionary in terms of government spending, etc. The things that, it's too early to hike rates, interest rates. So I think those are primary reasons why you got the Japanese stock market, which is rallying up a little bit more. Now, OPEC is adding more oil into the market, more supply into the market. So there are already concerns of a global glut. Remember, oil prices even on Friday, over the last 1 week basically, are down some 10%. So, prices have already reacted coming into this event. And I think, if anything, we got a bit of a move on the other side. China, nothing out of there. China, the Golden Week holidays, the onshore market reopens on the 9th of October. Now to tie in, a bit about India here those trade talks and, Indian delegation, US delegation meeting, trying to work out things, etc. It's quieted down, hasn't it? Especially over the last fortnight or so. But there's this Kautilya conference in Delhi at which the External Affairs Minister of India, Jaishankar, spoke. And he basically said that, he basically confirmed in a way that we've not arrived at a landing ground for our trade discussions. So not trade discussions themselves, but basically at a place where both parties can sit face to face and start to talk about how to resolve this. So that common ground has yet to be found. I said it has to be an understanding where our bottom lines and red lines are to be respected And there's more from that speech, which we'll put out later on. But I thought this was the operative and the critical part in that sense. So no real movement, I think, is the takeaway at this stage as far as the India-US bid is concerned. And that perhaps, as you've heard from many who've appeared on this program, on this channel over the last 1 month or so, is a big deal in terms of sentiment towards India, even if it's not really hurting at least the organized, the listed universe in a more meaningful, direct earnings-related way. I'll just tie in the levels. So the market, of course, has had a decent move last 2 days. Of course, especially after the Reserve Bank of India's measures for the banking space. So we closed around the 40-day exponential moving average. So we moved away from the hourlies to the dailies. The resistance now is the 50 and the 61.8% retracement of the prior falls for the market. So 25,018 is the 50% retracement, 25,120 is the 61.8% retracement. The support here, 24,587, it's the recent low, and that will be the same for the Nifty Bank as well. The Bank Nifty has continued its momentum. It's actually, if anything, done a little better, especially even prior to the RBI moves and after the RBI moves as well. And here the resistance now at about 56,528. Gift Nifty will give you a quick sense of how we're likely to start. We'll pick it up from there. I mean, banks and financials should be in focus. Plethora, it's a long list of pre-quarterly updates. Is a kickoff of the earnings season as well, which we are going to focus on. 50 points lower on the Gift Nifty. How's the F&O positioning looking like? Nigel's walked across to the wall. Nigel, over to you.
Well, a quick word on the cash market flows first. The FIs, they continue to remain sellers. However, selling has come down to around 1,500 to around 2,000 crores. And though we have seen a bit of a bounce in the last few trading sessions, no big signs of them covering their shorts as yet, at least, because they added close to 13,000 short contracts and the short positioning is at around 93%. And we keep talking about the FI net short positions, how it's gradually moving towards that 2 lakh contracts. For the time being, the net shorts are at around 1.9 lakh contracts. However, the client positioning, they have been building onto longs. And the long positioning now is at the highest level we have seen all the way since March 2025. So the clients and the FIs, they're in opposite ends of the spectrum. Sometimes that's not such a bad thing, because when you have shorts in the system, that's what could cause them to get squeezed out a little bit. But on the option side, they've continued writing some puts. And for the second straight day, the number of puts that are written are double the number of calls that were written. So that's heartening. Maybe in the near term, they as well are not factoring in the Nifty to go below that 24,300, 24,500 odd levels. Moving to the options data, then it appears there's a bit of a strategy that's playing out. Tomorrow, you'll have both these two strikes that will expire, because you have the Nifty weekly expiry now on a Tuesday. 24,900 call as well as put. Fair bit of open interest build up. You combine the premium between them, it's close to around 150 rupees, which gives you a broad sense in terms of the band. There could be possibly a short straddle that works out here. So 150 minus 24,900, 150 added to 24,900. And that's the broad range you're looking at. 24,750 to 25,050, important mark that we're looking at. But, you're looking at a couple of technical levels in the near term, both on the Nifty as well as on the Nifty Bank. So on the Nifty, the first line in the sand is around the 25,000 mark, which is the 20 DMA. And on the Nifty Bank, the 100 DMA comes into play. Keep in mind, the Nifty Bank went through 6 straight sessions of losing, and now we're on a 4-session winning streak. So the Nifty Bank has been leading the way, and a couple of big banking names, HDFC Bank and Kotak Mahindra Bank, the operational update is quite good. So we'll have to see whether or not the Nifty Bank can drive home the advantage. That's going to be important to track today. 2 stocks I'm looking at. Well, the government has gone ahead and they have revised the CGHS rate revision. That's the first revision we've seen in 15 years. A lot of stocks will be in focus, but Yatharth, since they get a bulk of their revenues which have exposure to the scheme, that's why, in fact, I'll keep an eye out on Yatharth. That could possibly be the stock of the day. I think we should get that one up for you on the screen. All of them have some exposure, but Yatharth could be the one. And we'll also look at AB Lifestyle. Remember, the stock has been under some pressure post its listing. There's a large trade. Once that gets cleared out, maybe you keep an eye out on that one as well. So both these 2 stocks will be on the radar for today.
Okay, all right. So those are the stocks to watch. In Asia, of course, many of the markets are shut for regional holidays. The one that just takes your breath away is Japan. And imagine that. I mean, from the April lows, the Japanese market has rallied 55-56% already, making it among the best performers around the world. And that's only continuing. today. Let's just bring up the implied open. So the suggestion is that it'll be 50 points, lower once again. That's been the problem with our market, that it's one step forward, one back, or maybe two back at times, or two forward and one back. And that is a pattern that has not broken. Will it this week? Well, we'll find out as we keep going through the cues. Matt Orton, Chief Market Strategist at Raymond James, is with us. Matt, good morning. Great to have you in. So, when we talk about foreign money and competition for India, it's been South Korea, it's been China, it's been Taiwan, and clearly Japan's not going out of the window. I was just looking at the past gains when the tariffs were announced in April. They were among the first countries to get that deal done, and the market's just been skyrocketing. So do you see these patterns changing in the near future at all? We know you like the Indian market, but the money's still been going out, foreign money.
Hey, good morning, Surabhi. And yeah, you're right. It's been a really strong market for a lot of the emerging markets. International developed markets, including Japan, just continue to push higher. And I'm optimistic about it. I have exposure to Japan. I've luckily recently increased my overweight prior to a lot of this news coming out with the LDP. But I think the bigger picture is really, really important here. It's that a lot of these markets are pushing higher because either they have exposure to the artificial intelligence theme. That's really been the critical driver of South Korea, of Taiwan, of China, even is the enthusiasm around artificial intelligence. Japan, on the other hand, has some of the best corporate earnings revisions across all markets in the world, coupled with stronger share buybacks, plus optimism around trade, and now hopefully a lot more fiscal spending that can support the market. So there's reasons that investors have been going there. I think India has fallen short just because of lackluster earnings coupled with higher valuations. But the Indian market's been pretty bifurcated. There's been a lot of very strong winners across the Indian markets for investors who do their homework, and it's been decorrelated from a lot of the rest of the world. So I like India as a risk management tool across my emerging market exposure. And for those investors who are willing to invest in high quality businesses that continue to compound earnings, India's been pretty good. And I think if earnings season's positive coming up, I think you start to see a change with respect to foreign investor flows.
Matt, morning. With regards to what you said, right, the AI theme and money going into this AI thing globally, just a quick word, this latest, if anything, and it's quite remarkable, if you look at the investment commitments which were made for the next 4 years by OpenAI, right? And you kind of sort of try and look through where all this money, it's $500 billion or something, right? So almost all of it is essentially going to a large US, Japanese, Korean, Samsung, for example, etc., right? It's a very large sum of money, and this is over the next 4 years. So, sitting here, you kind of sort of feel a little, it's a little underwhelming in that sense, right? You got this huge capex super cycle build out in terms of AI, which is happening, and it's accelerating, if anything, this OpenAI order. So what's your sense? How do you think about it?
When I look at artificial intelligence capex, Prashant, I think it's definitely the lion's share has been going to U.S. companies or the semiconductor exposed companies in Korea, Taiwan, like you mentioned. But there's going to be bottlenecks that start to come up. As I look forward to realizing a lot of the gains that are going to be associated with AI, a huge amount of those dollars are going into data center development. That's why electronic equipment companies have done so well in the US. That's why data center construction companies, connectivity, all of that chain that's created a very virtuous cycle. But there's not enough power that exists in the US. There's going to be regulatory problems that come up. So where I've increasingly been focused is where else can data centers be constructed that might not have such a big demand or imprint on power. That's why I think looking to Europe could be interesting as you see fiscal efforts start to come to fruition in countries like Germany. Maybe you're going to start to see a pickup with respect to AI data center demand, and you have a lot of the companies producing components located over in Europe. I think the same thing could potentially play out in a country like India, that geopolitically is still very strategically important for the U.S., still friendly to the U.S., and also has exposure to power, the ability to construct more power with less regulation. So I think that's something that's underappreciated by investors. And there's also companies in India that are starting to better integrate AI in the software layer that I think ultimately is going to be the long-term investment theme of artificial intelligence, that could provide a lot of enthusiasm, say, over the next 3 to 5+ years. So it's all about picking your spots and how you want to be positioned and how long-term you think about this sort of trade.
All right. Hi, Matt. Good to see you. And as always, give us, a couple of stocks then. How have you rejigged your portfolio? In the past, I think you were positive on the likes of Interglobe, Mahindra & Mahindra is a stock as well that you have liked. I think ICICI Bank, you've taken some money off the table. So tell us, what has been the recent rejig that you've done with regard to the India-based portfolio?
Absolutely. So I've actually started to add back a little exposure to ICICI heading into earnings season. I think the potential for retail loan growth might be a little bit underappreciated by the market. And the stock looks pretty cheap to me. So I like it. It's a solid execution management team. Building on this idea of artificial intelligence, there's names like Paytm that I'm looking at adding potentially some more exposure to my position if we see a little bit more weakness, because again, they're powered by integrating AI into their ability to convert active users and build a better integrated payment system. And a name that I've recently added into the portfolio is Apple3i. And this is another name. It's an ad tech company that's positioned around consumer engagement, but a huge portion of the revenue growth is levered to artificial intelligence and using tools.
Matt missed the stock. Which one are you talking about?
Apple3i.
Apple. Okay, got it. Yeah, please go ahead.
Yeah, so I like their integration of artificial intelligence into what they're doing. And given that they're an ad tech-led company, they do have an incredibly strong tech stack platform that I think is far and better than what a lot of other competitors offer. So I think it's not loved by the analyst community because it's expensive, but revenue growth has been there. Margins have been very, very strong. And I think that's another name that can surprise to the upside, that's levered to these longer-term growth themes that we've been talking about.
All right, Matt, thanks very much for joining us. You'll find those themes, those AI, the tail, and many of these themes actually, and some are up front as well. Looking at something like a GE Vernova. I mean, stock's done phenomenally well. It's up 10x in the last 3-4 years, but trades at some 100 times earnings. And but it's a play on the infra build out for AI data centers, etc. And they are a supplier to OpenAI globally, and of course, I mean, it's showed up here as well. Thanks very much for joining us, and good talking to you. We'll take a quick commercial break. Let me just tell you what the interactions are that are lined up here over the next 2 hours. So now 8:35, Nitin Agarwal of Motilal Oswal Financial Services talks about the banking updates, and there are many of them. 9 o'clock, we'll have Manik Taneja of Access Capital. We'll discuss his expectation in the IT sector ahead of the second quarter earnings. 9:20, Sanjay Mookim of JP Morgan talks markets with us. 9:35, Tata Capital IPO, big one, opens today. Ashok Chandra of PNB will be speaking with us at 9:45 to talk about their business update. And towards the end of the program, it's our special segment, Indianomics, Lata in conversation with former RBI Deputy Governors. H.R. Khan and S.S. Mundra. We also have Suresh Ganpati, analyst at Macquarie Capital, on the new banking dispensation post 1st of October policy.
Time to slip into a quick break. Got a lot of stock-specific action to track for you in our top 10 segment. For the time being, I'll give you a sneak peek. HDFC Bank, Kotak Mahindra Bank, Marico, Nykaa, Bajaj Finance, all of them will be reacting to positive news flow. Add to the list, Fortis Health. On the flip side, Aditya Birla Lifestyle, IndusInd Bank, Avenue Supermarts, and Vedanta is a stock that we'll be tracking. Take that break, come back, we get into further detail on all of these names.
Okay, so the cues across Asia are a little thin because some of the regional markets are shut. The one that is, up and about is charging ahead, and that's Japan, 4.5% higher. But that's not really rubbing off on the sentiment here for obvious reasons, because the suggestion right now is that it could be, once again, a slightly truncated or muted start after the good pickup on Friday. So let's talk about stocks because the market has been very, very stock specific all these last couple of weeks. So what is today's list looking like? Well, our team is standing by with a list of top 10 stocks that you need to watch out for. Guys, good morning to all of you. I think we're going to start it off with Gaurav first up because he's been very busy over the weekend looking at all of these NBFC and bank second quarter updates that have come through. Which one stand out for you, Gaurav?
Well, let's talk about HDFC Bank. Now it seems that the pace is finally picking up because the loan book growth has been at around 9.9%. Remember, that reflects 4.4% growth on a sequential basis. When it comes to deposit, that increased almost by 12%, but on a sequential basis, there was a slowdown. And as a result, the LDR ratio, that came to around 98%. Remember, bank wants to take it at 85 to 90% level. Another bank is Kotak Mahindra Bank. Again, this bank stood out well in terms of quarterly updates. Loan book growth was at around 15.8% on a year-on-year basis, and deposit growth, that also remains strong at around 14.6%. But at the same point, let's not forget that in the last quarter also, bank came up with good set of numbers, but it was driven by the corporate banking, and at the same time, credit costs also increased during the results. So we'll be watching out on that point. Lastly, let's talk about IndusInd Bank. Well, here we saw weak set of numbers, loan book that declined almost by 8% and deposits that declined almost by 5.5% on a year-on-year basis. Remember, this is the second quarter where the bank is actually reporting decline in loan book as well as deposits. So definitely a bit of a negative news for IndusInd Bank. So on the back of that, we will be watching out on this bank as well today.
Okay, so there are banks and there are NBFCs as well, which reported, and we're going to talk about Bajaj Finance. Remember, created a big flutter when they reported the last quarterly numbers and that commentary after earnings on the earnings call. But what are the numbers, the pre-quarter numbers looking like, Gaurav?
Well, when it comes to Bajaj Finance, they actually reported good set of numbers. When we look at AUM growth, that is around 23.6%, and that also reflects around 4.7% sequential growth. Now, remember, this stock is again in focus because of all the GST reforms. Every brokerage is actually being a bit bullish on Bajaj Finance because of the GST reforms. And on the back of that, Q2 numbers at least seems fair. Remember, management had also guided that 23 to 24% AUM growth is what they were looking for in FY26. So definitely in line with their guidance as well. Specifically, when it comes to customer base, now that has increased almost by 20% on a year-on-year basis. And they also added around 12.2 million new customers, which is addition of around 26% on a year-on-year basis. So definitely good set of numbers for Bajaj Finance. In fact, Bajaj Housing Finance, they also reported good set of numbers. Disbursements were strong. AUM growth again was in line with what the management had guided. So definitely Bajaj Group and specifically Bajaj Finance doing well in second quarter so far.
Okay, all right, Gaurav. Busy weekend prepping for the big day as well. Thanks a lot for joining in and giving us all of those details. Moving to the metals pack, Vedanta as well as Hindustan Zinc came out with their operational update and it looked a little bit subdued. So the stock could open up in the red. However, there will be some buying interest going by the kind of melt up that we have seen in metal prices. Hindustan Zinc first up. Out there you have the saleable metal production that's down by close to 6%, and bulk of that will be refined zinc. That production is mildly up by close to 2%. However, refined lead production, that's contracted big time by more than 25 to around 30% or thereabouts. And because of the contraction we're seeing in lead, silver production continues to lag, and that's a bit of a dampener. However, silver prices have moved up, so they'll continue to remain interest in Hindustan Zinc. But the better way to play the entire theme is normally with Vedanta, which holds more than 60% stake in Hindustan Zinc. Out there, the alumina, that's the Lanchigar refinery, has gone through an expansion. So the numbers up by close to 30%. Aluminum production is up mildly by close to 100%. And the international zinc business on a low base, that in fact popped up by close to 38%. So that's looking pretty okay. The problem is oil and gas. Out there, it continues to contract down close to around 15% on a year-on-year basis. While power in million units, well, that's on a seasonally weak quarter, so that as well was mildly lower. So give and take anything, it's a little bit of a subdued operational performance that's coming in there. So maybe some red on Vedanta, but don't rule out some kind of buying at lower levels. But the big stock of the day could possibly be Fortis Healthcare. Ekta joins us to fill us in with more details. Ekta?
Well, yes, it's after a delay of 7 years that IHH has received the SEBI nod to go ahead with the open offer for Fortis Healthcare and Fortis Malhar Hospitals. Now, to just give you a recap, IHH had bought 31.1% stake in Fortis for 4,000 crores in 2018. IHH's 26% open offer was set to open on December 18, 2018 and close on Jan 1st, 2019 for around 3,300 crores. However, it was stalled by the Supreme Court litigation. So in September 2022, IHH said that Supreme Court basically paved the way for the open offer, subject to SEBI approval. and now SEBI has given that approval for the open offer. Fortis is waiting for full information and should have clarity in a few days. I did speak to some sources in Fortis, and this is what they had to say. But the interesting part and the conundrum that they are going to face is that the offer price in 2018 for the open offer was 170 odd rupees. The current market price is 980 rupees. The stock is up 4.7 times since 2018. So it'll be interesting to see what the updates are going forward.
If I were IHH, I'd be feeling a little concerned with that stock price appreciation and the regulatory need to launch an open offer now at current market prices. But we'll see how this goes.
Yeah, absolutely. Well, AB Lifestyle Brands is the next one we're going to focus on. Vivek has got details here. Vivek, over to you.
Well, that's right. So AB Lifestyle Brands, watch out for this particular name. A large block deal is expected today. Flipkart Investments, that holds close to 6% of the total equity, is expected to completely exit its stake in this particular company. The offer price range for this particular block is at in the range of 130 to 136.5 rupees per share. And total of 6% of equity is expected to change hands. But remember, this is a clean-out trade. After this particular deal, Flipkart will no longer hold the stake as far as AB Lifestyle is concerned. Now, the total deal size is a little over 950 crore, a little over $110 million. So it's a large block deal. Expect some red at the opening, but may recover given the fact that the overhang of the Flipkart stake sale would be behind this particular stock.
Okay. All right, Vivek, thanks a lot for joining in and giving us that important information. That could be another stock that we'll be tracking today. Mangalam joins us to help us out with a whole host of business updates that have come in there. Mangalam, run us through the list.
Well, a lot of numbers that came in terms of pre-quarter updates. We start with DMart. What we look at is their standalone revenue grew about 15.5%. Not particularly bad because the last 3 years CAGR has been around 15.8% itself. So it's been largely in line with that. The good part is they've added 8 stores in the second quarter. First half of this year, they've added around 17 stores. Importantly, year-on-year store addition has been 14.5%, which implies a low single-digit same-store sales growth. The most important thing to watch for in DMart will be how the revenue pans out post GST rate cuts, because optically the revenues will reduce because prices of things have reduced as well. So that's something that the street will monitor in the second half of this year. Going with mild red on DMart. Marico, mild green out here because the consolidated revenues, that has grown at 30% plus. That's a big positive. But remember, it's because of pricing. Underlying volume growth in India has been high single digits, but there has been some moderation quarter on quarter due to high inflation in copra, and which is why the company expects modest operating profit growth on a year-on-year basis. So despite a 30% revenue growth, going with just mild green. And finally, bright green would be on Nykaa. Why is that? Because gross merchandise value expected to grow near 30s versus mid-20s in the last few quarters, and it's been led by fashion business. Beauty vertical has been doing extremely well, a revenue growth of mid-20s, so that's a positive. But fashion, which had been lagging for the last many quarters, has now come back, and they expect the growth to improve to low 20s from mid-teens out there. So a bright shade of green on Nykaa, mild green on Marico, and mild red on DMart.
Okay, all right, Mangalam got it. So we'll keep all of these consumer stocks on our radar as well. Let's quickly actually recap the list of stocks to track today. The ones that have positive news flow around them are on your screens. It includes HDFC Bank, Kotak Mahindra Bank, Marico, Nykaa, Bajaj Finance, Fortis Healthcare. The ones that have some negative news developments around them or earnings picture around them would be Aditya Birla Lifestyle, IndusInd Bank, Avenue Supermarts, and Vedanta. So mixed set of cues coming in terms of our stock list today. Let's now head across to Manisha to take stock of what's happening with the commodity markets, because we know that oil was making all the headlines last week. I think it fell 8%. And then there was this OPEC Plus meeting in focus over the weekend. Manisha, good morning. What's the latest?
Thank you for that. Well, almost everything in commodity seems to be doing quite well right now. After that decline that we saw in the crude oil prices in the previous week, and after that OPEC Plus meeting, which now tells us that the OPEC Plus increase in production for the month of November is much lower at 137,000 barrels per day, as much as it was in the month of October. You've seen some gains come back into the prices. So a percentage point and more is how Asia is trading. All-time highs continuing in case of gold prices. We've now not just broken above 3,900, but we've taken $3,925 an ounce at this point in time. With that, it's 50% up for gold. The prolonged U.S. government shutdown seems to be impacting buying in many of these tangible commodities. So you have silver yet again trading at around $48 an ounce. The Indian markets, as it opened, will be an all-time high for gold and silver both. Copper seems to be trading on a firmer note as well. We're looking at a 2-month highs onto this one. Bitcoin is trading at an all-time high in the Asian markets as well. So as I said, many of these safe havens, alternates, tangible commodities seem to be doing quite well in the Asian markets right now.
Okay, all right, got it, Manisha. Thank you very much for a quick roundup. With that, let's quickly, head to Sudarshan. He's been watching out for a couple of the interesting brokerage notes this morning. Good morning, Sud. So what's catching your attention today?
Good morning, Surabhi. So we'll start with JSW Cement, where there is an initiation. Jefferies has initiated with a buy call, and here target is rupees 170 per share. It's saying that despite the late entry in the sector, company has become among top 10 players, and now it has seen 13 to 17% capacity volume CAGR over FY15 to FY25, and it's diversifying from a regional focus to pan-India presence, and it's positioned for a profitable scale-up, and it estimates EBITDA CAGR of 35% over FY25-28. Next is PVR Inox. Investec maintains hold call and target is raised to 1215 from 1147 per share. It says FY26 is shaping up to be a strong year at the box office, and with this Q2 earnings are also expected to be strong, with revenue growth seen at 15.4%, and with this visibility to achieve FY26 revenue growth is now higher. But Investec continues to hold its thesis of content volatility risk in the long term that company might face. Next is Avenue Supermart. Most of the brokerages have come out with their notes post Q2 updates. First one is Goldman Sachs. It maintains sell call and target has reduced to 33,370 from 3,450 per share. It says growth is weaker than expected, with 15.4% growth that company has reported for Q2. Also, there is no meaningful acceleration in store growth, and because of these two, it has cut FY26 sales growth expectations to 18% from 20%. Also, it has reduced EPS estimate for FY26-28 by 2%. JP Morgan maintains neutral call and targets for 4,350, but it says Q2 revenue growth of 15% to weigh on near-term stock performance, and MS maintains equal weight call and targets 4,552 per share. It estimates implied same-store sales growth in the range of 3 to 4% for Q2 that company will be reporting very soon.
Okay, all right. So thank you very much. More later, but that's a flavor of the kind of brokerage calls that are coming in this morning. We'll take a quick commercial break here. We'll come back. There's, 25 minutes to go for market pre-open. Dharmesh Kant of Chola Securities. We'll talk some stocks with him coming up on the other side.
Welcome back and hope you're having a good morning. Well, while speaking at the Kautilya conference yesterday, External Affairs Minister Mr. Jaishankar spoke on the need for an understanding between India and the United States, where bottom lines and red lines are respected. Let's listen in.
Whatever happens, at the end of the day, there has got to be a trade understanding with the United States. There has to be one because it is the world's largest market, but also because it is, much of the world has reached those understandings. But it has to be an understanding where our bottom lines, our red lines are respected. In any agreement, there are things you can negotiate and there are things you can't. And I think we are pretty clear about that. And we have to find that landing ground. And that's been the conversation really which has been going on since March.
Okay, all right. Well, let's get in Dharmesh Kant, the head research at Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning and good to see you in. Well, there's been a hike that's come in for various hospitals, and the effective rates could go up drastically. I was looking at a DAM Capital note, and they are mentioning that could be a big kicker for earnings in FY27. What's your view on this hospital change? For Fortis, we have their additional news that the green signal has come for the open offer. But at what price is going to be crucial, because it's come after 7 years. Your view on the space?
Yeah, very good morning to you, Nigel, and everybody in the studio, and to all the viewers. Thanks for having me on the show. The news flow is positive. If it gets implemented, definitely there would be incremental EPS accretive with most of the hospital chain out there. And there will be some burden, getting off the public sector hospitals, which are already overburdened with the demand out there. So I think it's a move in the right direction and a welcome note. To our mind, I think Narayana Hrudayalaya remains the best beneficiary if it comes through in totality. The reason being their pricing has always been on the lower end of the curve compared to other private hospital chains. So, patients will find it more easier and still more price competitive as far as Narayana Hrudayalaya is concerned. And it is focused in Eastern India and certain parts of, Bangalore, where Eastern India still caters to the majority of the patients who are very, very price sensitive kind of a patient. So to my mind, valuation wise is comfortable. It's still trading at 45, 46 time on a P multiple on a trading basis. 1 year forward is 37, 38. And ROEs are the best in the industry. It has a ROE of 24, 25. So still a lot of scope and catch up can happen out there. Others are also well. They all are taking capacity expansions, but the valuations are far higher, 60, 70 kind of a P multiple. As far as Fortis is concerned, IHS has already turned around the company. 2018, they were reporting losses from there to 800 crores of profit. And with margins rising from 6% to 20%, they have demonstrated their, efficiency. And going forward, I think with this clarity coming in, more focus on aggressive capacity expansion can take place. But the catch in the point is at what price the open over is now going to materialize, and there's a significant differential. So we all excited to know that how this pans out. Stock prices moved up quite a bit, but I think this is more a positive news flow on the space. So entire space is we are bullish on, but we like Narayana as the best stock pick out there.
Yeah, I guess on Fortis, that open offer has to happen because, well, it's regulation. The question is now, how do they come to a pricing, if it's an average or what formula or how they come about it? We'll see. Interesting, as you said, Dharmesh Morning. I want to talk about the lenders and the biggest of the blue chip names to figure out now how you would read it. So Kotak's growth rate in this quarter is 15%. I'm just talking basic, book growth of the book year on year. HDFC Bank is not bad, almost 10% growth coming in. And then you have a, blue chip marquee NBFC like Bajaj Finance still clocking 24-25% growth. So as an investor, if I want to make a fresh investment between these three choices, give us your rank and pecking order and the reasoning.
Yeah, good morning, Survi. I think I will still go with Kotak Bank, and the reason being HDFC Bank did surprise with the kind of numbers they came out with. 9.9% was quite a good number. I was expecting 7 to 7.5 kind of a growth number out there. But the catch point with HDFC Bank is that CASA grew, but 7% was the CASA base, and term deposit grew by 14%. So there would still be a hit on the NIMs going forward, and Q3 as well can see a normalization of NIMs for HDFC Bank. Asset quality, it has always maintained a good set of asset quality. And so there may be some trading pop up there. But Bajaj Finance, again, on the expensive side, they have done well. I would love to see the management commentary this time around, because last time around the numbers were pretty good. But the management said there is a concern in the two-wheeler, three-wheeler segment, at the same time MSME segment. So what is the commentary now? Are those concerns over in light of the GST cut and all? So again, it's as pricier stock, 6 times price to book it is trading it. But Kotak has a comfortable and evenly balanced kind of a run rate. They are maintaining 16%. At the same time, deposit growth has also been fairly robust. Asset quality, last time there was a bit, turbulence out there, but I think this quarter things should settle out. Valuation wise, it's comfortable as compared to others in the group. So out of the three, Kotak remains a topic. Bajaj and SDFC would be a market performer to my mind.
Okay. We're just going to talk about banks with Nitin Agarwal, who's going to be with us in just a bit as well. But Dharmesh, good morning. Did you look at the DMart update? And what did you make of it?
Yeah, good morning, Bazaar. Yeah, I mean, 15% kind of a growth was there. And it's better than what they have done for the last 2 years. There has been a slippage again, it's been gaining back. Stores count remain the same. I think nothing great out there. And if you look at DMart, Prashant, 2021, it was 5,400 was the stock price. It is 4,400 now. And the reason being in last 4 years, the tapering of the CAGR has seen on the revenue and the PAT side. So last 2 years, it was 6.7% kind of a CAGR growth. Going forward, we think 10-12% is still doable. At the best, it can go to 15%. But nothing beyond that is the likely scenario. In light of that, if you look at DMart, is still trading at, depending on what kind of a valuation multiple, I mean, unless you are seeing 75 to 80 times 1 year forward. And on a TTM basis, 102 times, P multiple, with margins being where they are 13-14%. So to my mind, it's more of a, down rating, I mean, negative rating for DMart rather than a progressive growth. So stock will continue to languish where it is with signs of correction setting in.
Okay. Just stay on. We'll have more questions for you in just a bit, Dharmesh. But let's go back to the banking and the BFSI updates that have been coming in. We do have Nitin Agarwal, Senior Group VP Head of BFSI at Motilal Oswal Financial Services. Nitin, great to have you in. So I'll come to the big lenders later. We were just discussing this the same thing with Dharmesh before you joined in. Let's start with the non-nifty names that have reported, and a whole host of PSU banks in that list, including PNB. There are a lot of the small finance banks that have reported. So what stands out for you? I mean, I notice that most of the SFBs, I mean, no one's lighting up the charts with growth. It's largely, single-digit growth. So just tell us your trends, reading through the weekend updates.
Yeah, hi. Thanks for having me. And I think this time the business update has come out to be fairly strong. If you'll see, not much expectations were there from 2Q, while we did see some pickup in the business activity in the last 10 days out of September, especially after the GST cut. Otherwise, the commentary and even the RBI numbers that were running, for most of the quarter, were fairly kind of soft. And in context to that, most of the PSBs have reported a fairly strong growth. Across the board, we have seen growth ranging between 3 to 6% on advances on a sequential basis. And for SFBs also, the growth is for our coverage, SFBs is between 4 to 5%. So both AU and Equitas have reported a fairly healthy sequential pickup. And this is when MFI sector, we are still expecting trends to remain soft. There could be again a decline on a sequential basis in that segment. And only the Union Bank, as I see amongst the PSBs in our coverage, has reported a softer trend, and which is probably as the bank remains mindful of the pricing and is not growing aggressively in the corporate book at all. Otherwise, RAM growth, I guess, across the board for all PSBs will remain fairly healthy, something that we will see.
So in this universe, when we are talking tier 2 financials, tier 2 banks, would you have any picks before we talk about what HDFC has done and the other big boys have done?
Yeah. So certainly, we wrote our PSU bank thematic note just 8-10 days back, and we continue to remain positive on the space. And within the pack, we like PNB and SBI, of course, within the larger names remains our preferred buy. But besides that, we like PNB and Indian Bank within the PSU banks. And amongst SFBs, AU continues to remain our preferred idea. The stock has done very well over the last few months or few quarters, you can say. Only in the last after the last results, we did see some decline because of the MFI stress and some uptick in the credit cost. But we remain confident that by the time you end the year, I think the earnings will be on an upswing. And that, in context to how the bank will shape up as a transition to universal bank happens, will continue to drive a very strong earnings as well as a balance sheet CAGR.
Got it. Hi, Nitin. Good morning. Good to see you. Now, what about RBL Bank? There's some news that the street has been sniffing for a bit, unsure whether or not that will come through with regard to any kind of fund infusion. But for the time being, that operational update that they put up is pretty good. 14% growth is what they've delivered on the loan book. It's crossed 1 lakh crore or thereabouts. The stock has run up considerably from the recent lows. What's your view on the counter?
Yeah, certainly. So RBL the stock has done really well. We upgraded the stock around 8-9 months back. And while we continue to maintain a positive view, and we believe that as the MFI stress continues to recede and provisioning therefore comes down, you will see ROAs inching up towards 1 by Q4 is what the bank is guiding. And in our numbers, we are estimating somewhere around 1.2 in the following year. So as you see that earnings momentum is catching up and the growth run rate, what they delivered in this quarter is also pretty strong. It's a 6% sequential growth that the bank has reported. And it's the only bank in our coverage wherein we are expecting NIM expansion in 2Q. So as this also strengthens further, that will give more confidence in the earnings and their ROA delivery. And that will help the stock continue to do well in the coming quarters, we believe.
Okay, all right. Nitin, if I remember correct, I think you're also tracking the credit card business, right? SBI cards. The stock, obviously, over the last few years hasn't given much returns. But what's the view right now? There is an entire talk that, credit card spends will go up and the likes. Do you believe that the stock could perform from here on?
I think while the overall retail spends continues to track well, though it's not comparable to what it was, say, 5 years back. But last year, we did see some overall moderation in spends that was mainly because of the corporate spending, which came down very sharply. And retail growth continues to be somewhere in the mid-teens, we believe. And that number we feel fairly confident about. But the problems around asset quality is something that has impacted the stock performance. The running credit cost continues to remain elevated. And though second half should be better than the first half is what we are penciling in. But given that the overall number per se in terms of credit costs sustaining above 9% currently is something to be watched for. And margins, another key parameter, it has been trending up, but it's a very calibrated uptick that we have seen in margins, despite a very sharp decline in repo rate cuts. Now, if we go on to see some more repo rate cuts, which is a good possibility, then I think this will continue to aid the earnings recovery for the stock. As of now, we have been maintaining a neutral rating on SBI Card.
Okay, got that. Now let's talk about the private sector big boys. And here it's getting, it's a very interesting pitch, right? There's HDFC Bank, which is back to delivering almost double-digit growth, almost 10%, 9.9%. Though Dharmesh was just telling us that he, for instance, is still a little concerned about margins. So give us your view there. There's Kotak, no growth problems, 15% year on year. And there is IndusInd, where, of course, numbers are weak and it's not a patch compared to its peers. But there is clarity on leadership now, and a very well-respected leader has taken over the bank. So could this be the time to be looking at IndusInd beyond the near-term subdued performance?
Right. So 3 stocks you talked about. Yeah. HDFC, I guess, pretty strong business update. Advances growth certainly has come in better than anybody's expectations. And after a long time, we are seeing such a sharp rise in CD ratio. Otherwise, the focus for the bank has been to bring down CD ratio. But I guess Q4 will normalize it, because Q4 is the time when seasonally they typically report a very strong deposit growth. So on a full year basis, they will still be lower on CD ratio versus where they were at Q1. And but this advances growth certainly instills the confidence the bank is well positioned to deliver growth in line with the system. That's what their guidance is, that they will look to grow somewhere closer to the system, which we believe will be around 11. And so with this pickup in the advances, they are tracking well on that. And on margins, I think the decline will be very limited. We are penciling around 10-11 basis point decline for margins, and Q2 should be the bottom on margins front. Next quarter, because of the CRR cut and because of the gradual deposit repricing, I think margins will start to recover from the next quarter onwards.
And would you buy IndusInd now, going against the near-term concern? And obviously their growth is no comparison to the others for obvious reasons.
Yeah. I think IndusInd is a stock wherein this quarter one should not really look too much on the numbers, on the business update, because it's a management clarity and the execution, therefore, in the coming quarters, which matters more. And this quarter, while, yes, both the advances and deposits have been a slight decline, but the strategy going forward and the recovery in the core business, both in vehicles and microfinance, because these are the two segments which have induced a lot of stress, that will be critical, alongside the pickup in the rest of the business lines. And which is where we believe at the current valuations, downside definitely is limited. And as you get more clarity around execution and the management focus on the segments, and the outcome of therefore the profitability estimates will matter more. And we currently have a neutral rating on IndusInd, but certainly there is not much of downside that we see on the name as of now.
Okay. All right. Got it. Interesting take. Thank you very much. Lots of numbers there. Thank you for making sense of all of them. Need to take a very quick break. We'll come back on the other side. We'll have our technical experts, Sudarshan Sukhani and Mitesh Thakkar, joining in with some technical ideas.
Okay, welcome back. Let's focus on this 5 minutes to go, by the way, for the pre-open session. Let's focus on the big movers from Friday. Stocks which saw large price action, heavy volumes, and of course, we're looking at delivery stats as well. Hormuz is here with all of that. Hormuz, morning.
Morning, Prashant. And you start off with Astra Micro, because defense was one of the themes that was buzzing in Friday's trade after that Goldman Sachs note. And Astra Micro's 10% move was the biggest single day gain it saw since April of 23. And the stock also, and you look at the volumes here as well, it was close to 40 lakh shares that changed hands, the 20-day average of just over 5.5 lakh shares. And almost 6 lakh shares were marked for delivery compared to a 20-day average of just 2.5 lakh shares. So 3x in terms of the delivery volumes as well. We spoke of Sai Silk Kalamandir almost all through Friday's session after the business update, the way the stock moved, the biggest single day gain since listing, close to 4 crore shares changed hands there. The 20-day average here is less than 6 lakh shares. Even in terms of the delivery volumes, 50 lakh shares were marked for delivery, which is the sum total of the last 17 sessions combined. And that was a comparison to the 20-day average of just 3 lakh shares. And Friday's turnover that the stock had of 680 crore was 25% of the company's overall market cap as well, which is just over around 2,500 crore rupees. And of course, despite this move, the stock continues to remain below its IPO price. Now, Orient Technologies was the other one that had the biggest single-day gain since listing in terms of price action and volumes action as well. We had close to 70 lakh shares that were traded on the stock. The 20-day average here is just over 5 lakh shares. But out of these 70 lakh shares that were traded, only 1 lakh shares were marked for delivery. And the 20-day average here is only 15,000 shares when it comes to delivery volumes. And in comparison to its IPO price of 206, the stock has more than doubled. And lastly, an interesting name is KIOCL. And is the biggest single day gain since October of 23. The Friday's volumes were nearly the highest in 2 months. Now we had close to 1 crore shares that were traded on the stock. The 20-day average here is only 14 lakh shares, and close to 19 lakh shares were marked for delivery compared to a 20-day average of just over 2 lakh shares. Now the interesting bit here is that this stock does not have any free float in the market. The government holding here is 99%, and Friday's turnover was higher than its free float market cap, and a market cap of around 32,000 crore rupees. And the stock has negative EPS and negative return ratios, with KIOCL on your radar 20% higher on Friday.
Okay, all right, got that. Thanks, Ormaz, for the interesting buzzers. We'll take a quick break on that note, come back on the other side. We'll get the pre-opening rates and, of course, also focus on the expectations from the IT sector. Second quarter earnings season about to kick off. We'll get you prepped up. Okay, well, the pre-open rates have started trickling in. So we've got about a 40-point up move on the Nifty for the time being. We'll just get some of the major names, the banks that have reported earnings. Look at HDFC Bank. But it's very early right now on the pre-open, but still the indication is it's going to be a higher start. Ditto for Kotak Mahindra Bank as well. And let's look at Bajaj Finance. Bajaj Finance is flat. The reported numbers are about 24% growth for Bajaj Finance. We'll keep flashing these stocks as we go by, but let's also bring in our technical experts to understand today's trading setup and, of course, some of the stock ideas. Sudarshan, Mitesh, good morning to both of you. Hope you had a good weekend. So, Sudarshan, what's it going to be? I mean, index, long trades for today or for this week, or no, or staying out, only focusing on stocks? What's the idea?
Yeah, good morning. See, there is a mild uptrend. I don't know how long it will last and where it will go. But there is that big up move we saw on Wednesday tells us that we should be buyers. Look to buy on minor corrections. Keep a very tight stop at 24,800. This is not the beginning of a real up move. I don't think so. But for short-term traders, it may give something and may not. Buy on a dip, keep a stop at 24,800 and have very modest expectations.
Got it. Okay, all right. Got that, Sudarshan. Morning, gentlemen. Mitesh, coming across to you. What's your view? Last couple of days have been good, but now we're reaching that crucial 25,000 odd mark. What's your view?
Morning, Nigel. So I think that's the level which I'm watching very closely. 25,000 is an area where we have some moving averages as well. And the 20-day average, though, is at about 24,920. But I think 25,000 also has some weekly averages. So my sense is that while the market has managed to bounce back after a good decline, we have slightly come off the oversold levels. If we don't cross 25,000, then I think it could be a range between 25,000 to about 24,500. And that's where, the markets will consolidate for the next couple of weeks to come by. The interesting part in this entire equation is the Bank Nifty. One, it gave a very good breakout on the intraday charts on Wednesday and saw some follow through on Friday. I think 55,800, 900 is the first target area. We are not very far from there, about 300 points. But in case we start getting past that, then the Bank Nifty could lead the charge, and then the Nifty could also possibly have an upside move from the range.
Morning, gentlemen. Mitesh, what are your trades?
Morning, Prashant. So I have more of buy calls very clearly, more buys to sell. I have one sell, and that is on Lora Developers, which made a fresh swing low. Sell here with the stop at 1136 for targets of 1,070. While on the buying side is Nuvama, gap breakout, good price and volume action on Friday. So buy with a stop at about 66.90. Look for targets of around 68.90. Also a buy on Shriram Finance with a stop at 635 for targets of 665. And a buy on MCX, which I would recommend buying with a stop below 80.50 for targets of 83.50.
Okay, all right. So those are, mostly all long ideas from Mitesh. Sudarshan, what about you? What do you have?
Yeah, I'll just tell you. But Prashant, are you aware that the NSE IX is going to start daily zero DT Nifty options from 13th of October?
Yes.
Essentially, Nifty options that will expire every day.
Yes.
Obviously, it's not for Indian residents, but that's very interesting, and I wonder how it will affect us.
No, absolutely. Yep.
Granules is a buy with the stop under 549. Kalyan Jewelers is a buy with the stop under 481. It's an all buy list. United Spirits is a buy with a stop under 1337. And Tata Tech is a buy with a stop under 693.
Absolutely. Thanks very much. And Sudarshan, thanks for pointing out. We sort of planning to do something around it to on those options, daily options products, of course, on the Gift City. Thank you very much, both of you, for those trades as well. Now it's time for our special quarter segment where we are kicking it off with IT in focus. Rima is here to set the stage for Q2 expectations across large cap, mid cap companies. Rima, take it away.
Thanks so much for that. So this quarter for the Indian IT companies is expected to be stable. But so far, there are no signs of a demand recovery. The good news is that unlike in the past few quarters, there is no further deterioration in demand. So here's what the CNBC-TV18 poll looks like. So constant currency revenue growth for TCS could be muted, just about 0.2, 0.3%. Off the lot, Infy is likely to lead with about a 1.8% gain. HCL Tech stands at 1.5%. What will work as a tailwind for Indian IT companies is the INR depreciation. The rupee has fallen nearly 2.5% against the dollar, and that will act as a tailwind for margins and protect the margins against any AI-related deflation or pricing pressure. So margins will look better. For Infy, margins are likely to go up by 50 basis points. For TCS, close to about 20 basis points. Company specifics will matter. For TCS, for instance, continue to watch for the tapering of the BSNL deal, and even if this whole JLR rover cyber incident has had any impact. For Infosys, as always, the FY26 guidance will be at the center of all investors' attention. The current guidance stands at 1 to 3%. The guidance could be tweaked. Maybe it stands at 2 to 3%. But the guidance for Infy will be material only if the upper end is raised. That's the 3% mark. For Wipro, as always, it's a test of the company's turnaround story. For Q3, the street is penciling in a guidance of 0.5 to 1.5%. HCL Tech, FY26 guidance likely to remain unchanged at about 3 to 5%. For Tech Mahindra, watch for the margin reset story and the commentary on the telecom vertical. But across the sector, what investors will watch for, whether the AI-led renewal deals are getting traction, if AI is getting monetized beyond pilot projects. And the other, watch point, and which has captured, so much of the investor attention, is the impact of the H-1B visa costs. Is that going to hurt on-site delivery, the cost structure? What about fresher onboarding, headcount, overall attrition? All these will be important signs of demand visibility going ahead. And of course, markets will wait to see what TCS and Wipro have to say about a potential buyback after Infosys recently announced one. The big question all investors are grappling with when it comes to IT is that it's an unloved sector. It's not done anything. It's a serious underperformer from the start of the year, down about 25%. So does it turn into a value buy? Just to put the valuations in context. Now, historically, large cap IT companies used to trade in a band of 15 to 20 times forward multiple. TCS right on top. Then you had the pandemic boom and the valuations dramatically increased to about 25, 30 times. And for mid caps, it went as high as 60 times. But again, over the last 2 years, as demand has slowed down, valuations have actually come down and come back to long-term averages. So today, an Infy, TCS, HCL Tech are once again back in the 17, 18, 19 times range, valuation multiple, which is fine until you look at the growth expectations. For FY26, this is the Jefferies have pulled that up. Look at the numbers, right? No growth for TCS, just about a muted, 3-4% growth for Infosys, HCL Tech at 6%. So we're talking about low to mid-single digit kind of a revenue growth. And that is the big question. Is it a contrarian value buy today, or is it still too early to buy? Back to you.
Okay, all right, Rima, got it indeed. And that's the interesting question. as we get into this season that you have to look beyond the near-term weakness and look at a tactical buy or not. Manik Taneja, Executive Director, IT Services and Internet at Axis Capital is with us. Manik, great to have you join in. So let's talk about the bare basic numbers like Rima's put on the table that, expect between 0.5% to, in best case, maybe up to 2% growth, if at all, this season for the large cap IT services companies. Now, going beyond looking at the second half, do you expect any acceleration or pickup in spending? Or do you think this year will be more or less the same? So let's get the growth question out of the way first. Are you expecting a pickup this year? And then how does FY27 look like?
So first of all, thank you for having me. And with regards to your question as to whether things pick up or not, but in general, over the course of last 2.5, 3 years, every few months, we tend to get excited about CY24 becoming better, CY25 getting better, and CY26 as well. But almost all the time, these hopes have got dashed. And I would say it's a combination of aspects at play. As of now, with whatever Accenture has guided for their fiscal, they are not pointing to a significant acceleration. Street, including us, are building in some normalization in growth, but do we see a flush in terms of spend similar to what we saw post-COVID? I think the answer to that is no. And it is continuous, basically reset in terms of growth expectations that are now finally essentially getting acknowledged in the multiples for the sector as a whole. And today, if you look at, as Rima was also pointing out, tier 1 techs trade at similar to lower multiples compared to last 3-year, 5-year averages. We've seen multiples even come off for the tier 2 coverage, but they are still trading at on par to slightly higher compared to last 3 or 5-year averages.
Absolutely. Manik, one more point on growth. Now, we saw the reaction when the whole H1B news was announced. We saw that play out in stock prices, and stocks have corrected as well. So has the market fully priced in the H1B overhang? Or could it continue? Because we know that it's not a near-term hit, it's a one-time fee, etc. But the point is that given the chatter around offshoring in the US, could it now start being an overhang on deal closure conversations? Could it then therefore push back, deal timelines and getting any fresh business? So to that extent, when the commentary comes out of the second quarter, are we at risk of hearing another negative?
So certainly, as we've also mentioned, that H1B is a far more manageable risk for the sector as a whole. But as you have also pointed out, this plays a role in terms of potential deal discussions as to how customers are approaching it, and thereby do they take a more calibrated approach, especially with the way US administration essentially is thinking about outsourcing / offshoring from American companies. And thereby I would say no American corporate would want to be very vociferous in terms of saying they are signing up a large mega deal with an Indian outsourcer and then be in the eye of storm on Truth Social the very next day. So thereby that does impact the setup for Indian companies. Do these companies have an immediate way out? I would say the answer is no. Some of these global companies work with these vendors, also have their GCCs, and whether it is an Accenture or an IBM or even the JP Morgans of the world, all of them essentially use Indian talent for supporting their technology needs. So I would say people will try to essentially work around with these regulations, but certainly have an impact on the way deal discussions progress.
Yeah, which is why that question of is that another growth risk? But okay, very quickly, we're hitting market opening. In terms of stocks, what to do? Is there anything on your buy list at all? If not large cap, maybe mid cap, where the growth rates are relatively better off.
Sure. So I will first of all say, since you guys have been highlighting that the stocks have come off and it's an unloved sector, just look at global tech services over the course of last 5 years. The likes of Accenture, likes of Cognizant, likes of EPAM, Globants, the world would have delivered very modest returns to probably even negative returns. So the despondency in Indian IT is only catching up. The second thing that I would say from a sector standpoint, from a rating standpoint, Infosys and Wipro essentially remain our preferred picks amongst large caps, emphasis amongst the tier 2 techs, and we have a buy on both First Source and Sagility in the tier 3 universe. So we'll continue to stay very selective in terms of our ratings.
Yeah. All right. Thanks very much, Manik. Appreciate you joining us. We've got about 22 points on the Nifty and about 70 points on the sensex at this point. And that is essentially where the pre-open rates have settled in. I don't think we have time to look at stocks and how they're opening up in the pre-open. So we'll just sort of come back a bit on these names. The first rate starting to come through shortly. So 24,916, absolutely flat. Nifty Bank is up about 0.4%. Small cap index is up about 0.25%. And this is where we are at. So it's a very, very staid, but decent open. 900 up and about 650 lower is where we are beginning today's trading session at. Nifty heat map will give you a quick sense of where we are starting, and then we'll get to individual names, lots of pre-quarter updates, and some other movers as well. So it's kind of evenly split right down the middle. So some of the hospital names like Max, Apollo, etc. are there. On one end, there's HDFC Bank. On the other end, there's Power Grid, Sun, Nestle, etc., which are coming through as well. So this is the market open, 40 points higher to start this Monday. Surbhi.
Yeah, absolutely. It's all the banks, frankly. 0.5% up on the bank Nifty. And that's the only silver lining, so to speak, because these updates have looked pretty good to almost robust in some cases. So HDFC Bank with its 10% growth year on year, stocks up about 0.7%. There's ICICI Bank, which is rising slightly as well. Axis is managing about a move of a little over 0.5% at this point in time. Kotak Mahindra Bank is flat. It reported 15% growth, but for the time being, the stock isn't doing anything. The hospital stocks, of course, are excited because finally, after a good 10 years, CGHS has decided to revise hospital rates, how much it's paying for patient charges across hospitals. Max has a good exposure, so 3% up, making it the best performing stock on the Nifty right now. And Apollo as well, in quick succession, up about 2%. Okay, then I'm back to financials. Shriram Finance, 1.5% up. Bajaj Finance showing a growth of 24% in the quarter gone by, 1.2% up. So it's really financials that are saving the day. And the other good part is that at least IT is not falling. TCS 0.25% higher, Infosys also at least slightly positive right now. So it's not a downside drag. Actually, on the downside, there isn't too much. For the Nifty, there's Cipla, there's SBI Life. Some of the defense stocks like BEL are cooling off. Last week, we had a good rally in some of these large defense names. And then you have something like Titan and L&T on the lower side as well. But otherwise, it's financials all the way. Nigel.
Well, that's right. On the downside, Hemisphere Properties, I'm not sure what's happened there. But, that's down close to around 15%. So sharp downtick is what we're seeing on that particular counter. We'll just check. It's falling on rather large volumes as well. So just keep an eye out on that stock. In terms of hospital stocks, the CGHS rates have been revised. And a company that's a listed company that has a fair bit of exposure is Yatharth Hospital. So that one, in fact, is opened up with a gain of close to around 4%. Volume's not very, very high, but that has a relatively higher proportion of their, revenues that are linked to the scheme. So that's why, in fact, that stock is up and about. The other one is Aditya Birla Lifestyle. That large trade had to take place, 6% equity getting sold out. And, that happened in pre-open. So that's up close to around 10%. Big up move is what we're seeing. I recall when it got listed on the exchanges, in its new form. At that point of time, we did see the stock listed on 165 odd. From there, it pulled back. Now that this large trade is out of the way, well, it's popped up in trade 9% or thereabouts. On the downside, L&T Finance is under some pressure. That's down close to around 3% as we speak. So some bit of selling pressure out there. And metals continue to do well, because of the melt up we're seeing in pricing. So Vedanta, no great shakes with regard to their quarterly update. But the street is looking ahead now, with regard to what's going to happen with regard to the demerger. That hearing is due. And that's why the stock has recovered. Even Hindustan Zinc, the only way to play the silver big catch-up that we're seeing. Silver is approaching $50 an ounce yet again. So that's why that's up close to around 1% or thereabouts. And Hindustan Copper as well. With copper at multi-month highs, well, that one continues to move ahead. Demand is relatively strong. And we have a bit of a supply issue globally as well. So that's why that one up 2.5%.
All right. So yeah, I mean, it's a quiet start. 24,925 or so is where we are at. Sanjay Mukim is now joining us. He's a head of India equity research at JP Morgan. Sanjay, good morning. Great to have you with us here in the program. Thanks very much for joining us. I don't know if you heard our External Affairs Minister S. Jaishankar at that conference in Delhi talking about India. He was essentially basically saying that we are yet to find common ground for talks to take place with regards to resolving these issues. So I'm just sort of summarizing this in one line. So it does give you a sense of where we are at. I mean, if this is an issue, an impediment for the market, sentiment-wise or otherwise, the minister essentially saying we are perhaps still in very early stages trying to establish the broad framework on the basis of which we have to agree what we are going to talk about in that sense. That's what it seems to me. Sanjay, how do you see this and implications for markets?
Morning, great to be on. I think, look, you can't deny that it is an overhang for markets. What degree of an impact the lack of a India-US trade deal is very difficult to assess, of course. But what I'd also suggest, is that, look, other markets around the world are doing very well for intrinsic reasons. So the tech rally everywhere, the rebound in China, the rebound in Korea. So yes, maybe let's say an India-US deal could alleviate some of the pressures on the Indian equity market, and you may see a bounce on the announcement of one. But it may not necessarily be redemption for the underperformance that we have seen so far for MSCI India. You need a little bit more bottom-up push, I expect, for this underperformance to close.
Sanjay, hi. Great to have you with us this morning. So much going on. We are running into yet another earnings season. And, if we just go away from the global noise and what the US administration is doing or isn't doing, at the end of it, it boils down to earnings, right? And that is where we are yet to see any sort of a meaningful pickup. Now, are we at an inflection point where that changes because of all the policy stimulus, GST cuts, RBI, etc.?
Good morning, Surabhi. I think we could be at one. And this was one of the themes at our conference that we recently concluded. And, I was worried that participation might be soft given that markets been flat. But there was a big vote of confidence. A lot of people showed up. And one of the things that everybody was trying to explore was this. There has been a lot of, let's say, stimulus affected through the tax cuts, the GST rationalization, of course, combined with the rate cuts that you've seen. And this could lead to a revival of consumer expectations. Now, this is not likely to show up in numbers for the September quarter because the cuts happened very late, of course. But I think the results season this time around, there will be a lot of focus on how companies talk about the upcoming quarters. Have they seen a change in inflection? Have they seen a change in consumer trends? And therefore, there is this possibility that you get a little bit of momentum in earnings, especially given that we've already cut our numbers quite a bit in the last few months.
All right. Hi, Sanjay. Good to see you. And as always, what about the FI behavior? What are they thinking with regard to India? We used to be a darling till, 12 to 18 months ago. And that selling has been relentless. Though, thanking our stars in the last week or so, that cooled off a little bit. But they continue to remain net sellers. Their holding in the Indian markets is at a multi-year low. And in the FNO market as well, they're net short. Do you think that there are signs that gradually at these valuations, with the kind of measures taken both on the fisc as well as on the monetary side, and the hope that earnings come back, the FIs gradually start piling on the Indian stocks yet again? Or do you think that still has some time?
We'll see how the plays. These are very difficult things to anticipate in the short term, of course. See, India, everybody agrees, has a lot of potential in the long term or the medium term, right? There's all the known tailwinds of continued urbanization, the manufacturing drive that the government's pushing, urbanization, that's likely the demographics that everybody agrees to. So those factors sustain, and India therefore remains a place of inquiry for everybody for the long term. I think the challenge, at least in the near term, is the fact, like I was saying earlier, that other markets have delivered much sharper bounces. There's greater clarity on many others, let's say, tech-related sectors, of course. And a lot of investors were not necessarily positioned to participate in those rallies early on. And therefore, you see continued rotation out of India, which had been owned by them for a while, into these newer momentum areas. So until you see that reverse, the relative argument reverse, I'm not sure you're going to see too much of FI flow come back just because the markets underperform.
So Sanjay, what you in a way What you're saying is it has to be someone else's loss for the market here to do well. So let me explain. I don't mean it literally. Basically, from what I understand, what you're saying is money is going into themes like artificial intelligence, infra build out there, etc. You don't have very much here to as plays on that. So at some point that reverses, and then people start to sort of look at other areas. Right now, it's all concentrated in one big theme globally. Is that what you're saying?
It's not just one. There's let's say the stimulus in China, the rebound in Korea that you saw as well. So tech being just an example that I was using, Prashant. So I'd argue that, look, equity investing is a relative game. And if you have greater confidence of earnings momentum, and let me just highlight this one point. EPS expectations for the S&P in the near term are actually being upgraded. Right now, you can debate why it is happening. It's only tech-driven, or that you will cut them too much after the Liberation Day tariffs, etc. But nevertheless, for equity investors, you're seeing upgrades in the S&P EPS number. How sustainable they are, we can all debate. But in India, we have not seen that earnings momentum as well. So you need to start to, let's say, catch up on those trends, deliver some bottom-up momentum before you can claim some interest from foreign investors.
Sanjay, on that point, I know it's a little out of subject for us sitting here talking about India stocks and India earnings, but since you have that worldview as well, and you met so many people at the conference, there is some chatter that's starting about whether global markets, starting with the US itself, is now, in the build-up to a bubble stage. And I read some stuff over the weekend as well. I mean, private credit in Europe has gone all over the place, and there was a bankruptcy over the weekend, and then there was some, murmur of, we all remember how we got to that point of 2008, right? So I'm not saying this is anything similar, but is that a concern? Because then all bets are off, right? I mean, if we are at that point in global markets where perhaps there's a bigger correction coming. I mean, look at what's happening to gold. It's just going up, and central banks are buying, not just speculators. So just your views.
Well, this could be a very long discussion, of course, Surabhi. But look, Archie suggested that the markets or economies seem to be in some sort of bubble stage. Whether we are mid-cycle or late cycle is extremely difficult to pinpoint. But there are excesses clearly. The only saving grace, I'd argue, is that corporate balance sheets nowhere seem to be very leveraged. So unlike, let's say, 2008, as you referred, there doesn't seem to be a leverage problem in the corporate sector, but possibly a leverage problem in the government sector, where governments have borrowed, debt to GDP has gone up materially. And consequences of those might actually filter through into economies. But we don't expect, at least personally, I wouldn't expect much of a corporate sector blow up, because there isn't much leverage in the system.
Yeah, that's good to hear, and good to have that reminder, so we don't have to get too worried. So which brings us back down to, how people should look at their India portfolio. I mean, and there's this other debate, capex versus consumption, saying now, do you need to unload a bit on capex and move some of that money to some part of consumer? And where are you on that? And within consumer, where should the focus be? Because it's a very large basket overall, consumption.
In the near term, I think the answer is very, very evident, Sulpi, that the stimulus that the government has affected, I mean, we should hesitate in calling it a stimulus. It's a shift in policy preference, if you will, because the fiscal deficit will remain at, I would expect, 4.4. You're just taking, some money I expect from capex-related spends to the tax cuts that have gone through. And combined with the rate cuts, there is enough of a momentum for mid-income households to reconsider their purchasing decisions, right? There is that consumer stimulus. So looking at more consumer-related stocks in the near term makes a lot of sense. Now, the challenge, of course, investors face is many of the stocks have already gone up. So the question is, where is it not priced? Are further surprises likely? And we would argue that where there is elasticity to the price cuts that have come through is where we would continue to look at. So maybe some of the auto-related names make sense. The discretionary, obviously, you'll have greater elasticity to price cuts than staples. So those are the sectors where, I would agree with the consumer over capex in the near term, but more discretionary than staples.
Yeah, and that's been your call, Sanjay, for earlier this year as well, I recall. And that call actually has gone very well, because staples have still not picked up. The growth is extremely anemic. And with this GST 2.0 boost, discretionary could get a further boost. That said, how are you feeling about the markets? You're sounding a little bit somber still, and earnings have not yet picked up. If earnings don't pick up to the extent possible, a lot of newbies in the market, they are frustrated last 12 to 15 months. In fact, the index itself is lower. Do you think we could brace for a couple of years or maybe single-digit returns itself on the index, and that would be a good case outcome?
I would lean towards that. Now, the issue, of course, is that the higher multiple that you buy it, and this chart is clear over the last 20 years, the higher the entry multiple, the lower the future returns. Right? These are very self-evident, I think, pronouncements. And so if you do buy equity assets at current valuations, your expectation of future returns cannot be in the double digits on the index ETF. Let's say. If you are able to, let's say, buy stocks and some of them deliver returns, that's separate. But on an index ETF, you should not expect very high returns if you're buying at current multiples. On your first question, of course, Nigel, is on what we think of the markets. Look, it looks like you could see a little bit of a bounce because, like I said, expectations have been right-sized, earnings have been cut. Valuations for the Nifty are at 10% on discount to the S&P 500. And India tends to track the S&P multiples reasonably well. Plus, of course, we have this hope that December's March quarters turn out better for the consumer-facing stocks in the economy. So I wouldn't get too negative on the index itself. In fact, I would argue that there's probability of a little bit of a bounce in the near term.
Yeah, no, absolutely. I'll just quickly run you through what's happening. Just take a quick look at some other stuff which is happening, right? 10 points, by the way, on the Nifty. So 24,885 is where we are at. BSC is picking up a little bit. It's up about 3.5%. And stocks at about 2165 right now. Of course, lost a fair bit from the highs of about 3,017 or so. Basically lost $1,000 clean from the highs in August to where the lows were recently. The one bit of news flow, and we'll have to, see. There's actually, the thing is, there is no news flow, and that's the reason why the stock is going up. The news flow, which was that consultation paper on, futures and options segment, and whether weekly options should be, just discussing whether weekly options should be done away with, and the focus should be on longer tenure derivatives, etc. Now, the SEBI member who's kind of spearheading this is retiring this week, end of this week. And, will we see something over the course of the next 5 days? Or will it be, a new person who sort of starts to come in and kicks this off, in a fresh way, fresh look? And, does that provide some amount of relief to that category of weekly options product? I think that is what remains to be seen. I'm not sure this is related, the move is related to that, but I thought it's interesting to just highlight what's happening there.
Just one more point, Prashant, on BSC, the stock, I was just reading a sales note that came out. The stock is trading at around 38 times its forward multiple. And that's a 15% discount to the last 2 or 3 year average. Yeah. The stock has corrected, as you said, 30% in the last 4 months. And another note is suggesting that the impact of this weekly expiry swap hasn't been as much as what they feared earlier. So, looks like a whole host of factors that are coming together, and that could be one of the reasons why the stock is up. Just one more stock, Hemisphere, we were talking about it. Hemisphere Properties, the stock is now down, I think, close to around 15%. On the exchanges, they've noted that they put out, a property in Pune on e-auction, and the bids didn't come, on expected lines. So that's the reason why that one is down close to around 18% or thereabouts. It was put up for auction between the 1st and the 3rd, and no bids came in. So that's why that stock is down close to around 17 to 8%, probably the reason.
The other big stock, not big stock, but the big M&A which we reported on last week was Sammaan Capital. Now, Sammaan ended kind of flattish, slightly lower, 1%, 1.5% by close on Friday. It's down 3%. It's got the largest volumes on the NSE right now. Number one volume traded loser. It's a 3% cut, not very large, but 150, just under 160 is where it is at. Some of these are just pure reversal moves. AG's Logistics went up sharply on Friday, so it's giving back a little bit. I can spot Premier Explosives, which is up very, very sharply right now, which is up about 6% or so. So lots of new things into the mix as we track markets. E2E Networks is up another 5%. Maybe we should look at NetWeb as well. NetWeb, I think, had a blowout September, and it's, I think, taking it a little easy this morning, down about 0.5% or so. Let's just focus on Avenue Supermarts, which is D-Mart. And let's go across to Mangalam to run us through what the quarterly update looked like. Mangalam, over to you. Morning.
Good morning. So DMart, is lower in today's trading session. There were no great shakes in the quarterly update. Nothing really to write home about on both the upside or the downside. Why do I say that? Because, the standalone revenue grew at around 15.5%, which is pretty much in line with their 3-year average of 15.8% growth. So no great shakes on either the upside or the downside. They've added 8 new stores in this quarter, which is basically, the first half of this year. Around 17 stores is what they've added. The company has been looking to accelerate their store addition, so that's something we'll be watching out for going forward. Year on year, the store addition has been 14.5%. So you would say 15.4% revenue growth, store addition of 14.5%. Implied same-store sales growth is on the lower side, closer to around that 1% mark. The reason why the stock is sharply lower, despite having corrected from levels of around 4,700, 4,800 earlier, is because the street believes that going forward, the reported revenue would be a lot lower than historical rates because of the impact of GST cuts. So now something that was charged at around 18% or 12% coming down to 5% would imply that the MRP goes down, and as a result of which the DMart selling price goes down, and that would reflect in their revenue. So volume growth will be very important to track. Performance of DMart Ready is something that the street will be tracking, as well as quick commerce speaks about competition easing out. And finally, the store addition outlook, because that's something that everyone's pinning their hopes on when it comes to growth for DMart coming in, especially from Uttar Pradesh, where they recently opened a store.
Okay. All right, so Avenue Supermart under pressure today after that Q2 update coming through. Mangalam, thanks very much for that. But for the timing, let's move on. And it's IPO Street, which is buzzing and as alive as ever. Today, it's all going to be about a large issue that's coming to the market. Tata Capital's 15,000 crore rupee IPO is opening out. It is the largest issue of the calendar year so far. And we have the main gentleman with us, Rajiv Sabharwal, Managing Director and Chief Executive Officer of the company, joining in. Mr. Sabharwal, thanks so much for joining in. And, it's a pretty momentous time. Every time a Tata Group company comes to the public markets, obviously there's a lot of excitement. Now, people really want to understand the business and what your vision is going forward. Because if I look at the FY25 performance, then the overall growth was, absolutely, it was a blitzkrieg over there. I think 40% growth, right, on the book. However, there are those who also point out that your yield on advances and margins have been lower than your, peer set NBFCs. So, is this going to continue, that you will focus on that kind of growth, even if margins, say, remain slightly lower than the average? Or is there going to be a change once you become a publicly listed entity?
So, if you look at our overall growth, we had the impact of the merger of Tata Motor Finance last year in FY25. Though we got the merger approval in May of this year, the merger dates back to 1st April 2024. So if you exclude Tata Motor Finance book, we've been growing at 25% plus over the last few years. We believe India provides that opportunity of growing at that space. And it also happens because we are present in all segments. Retail and SME, which form about 88% of our book, itself grows at about 17 to 18% in the Indian credit market. And besides this, we are also present in the corporate space. So being present helps us. In terms of margins, I think our margins should be looked at with perspective to our credit costs. Our credit costs have been the least in the industry. If I take away the merger of Tata Motor Finance, Tata Capital has always had credit costs of below 1%. As far as the future is concerned, I think we've always looked at how we can add new products and grow them, which provide better margins. If you look at our housing business, affordable housing is the fastest growing segment there. It is growing at over 30% over the last few years. And we are among the top 2 or 3 companies in that space. We always look at that.
On affordable housing, Rajiv, good morning. Most NBFCs we speak to, they kind of lament the fact that affordable housing is a segment, when there's not enough stock on the affordable category to fund. That's the feedback that we have gotten occasionally. Is this on Tata? I mean, is there a lot of group? I mean, are you lending to, say, Tata Housing and developments, etc. there?
No, that is a very small portion. Okay, that's not the big thing. But when we talk about affordable housing and the stock being limited, we are actually talking about the organized developers. But if you purely look at affordable housing, it's largely a self-construction market. 80% of what we fund there is actually self-construction. When we go deeper into the markets, that's where we realize the real India is throbbing and alive. and there is a lot of activity.
So how does the loan book break up? I mean, so retail is about 60%, right? And that includes housing is within that. So just give us the broad areas where...
So, Brian, if you look at our book, about 63% is retail. Roughly half of that would be housing, and half of that would be other consumer loans. About 25 to 26% is SME, and the balance 11 to 12% is corporate.
Just to go back to the point on margins and yields, I guess it's also a function of, because all put together, I think over 70% of your book is secured, right? I mean,
Actually speaking, if I talk about retail unsecured, which was in
big talking point last
year, that is just short of 12% in our total book. So largely our book is secured in nature.
And do you intend to keep it that way? Because for a lender, that's always going to be that question to ask, the trade-off between higher yielding unsecured assets versus secured, slightly lower yielding assets. So do you intend to keep it at 12%?
So our approach is to create a very resilient book, an asset book which should not only do well when times are good, but should do well also when times are not so good. In terms of our mix of retail unsecured, what we have seen in the past few months, that the worst of credit cost is behind us. We will watch it over the next few quarters, and if things go well, we will look at accelerating that growth too.
Consumer segment,
the unsecured part of it.
Rajiv, consumer segment is 30% of the loan book, right? Consumer finance. And SME is another 26 odd percent. The GST cuts that happened, it's supposed to show up in a big way. I mean, I've spoken to companies like Bajaj Finance, etc. as well. These are the two areas where it's supposed to have an outsized impact. Are you already starting to see some of it?
Absolutely. This is actually, if you look at it, it's a very significant cut. It's not a small tinkering, it's a big cut. And the impact is visible whether you talk about PVs, CVs is still taking some time, but if you talk about two-wheelers, tractors, I think this is clearly visible. I think there are some products where the impact is immediate. There'll be some products where through the raw material, the impact will be seen over the next 3 months or so. So I think we are really expecting Q3 and Q4 to be really bumper quarters for this year.
All right. Hi, Mr. Sabharwal, and thanks a lot for coming down to the studio. A couple of quick questions then. Part of the issue will be a fresh issue. So how does it change your return ratios? If you could give us a sense on that. And also, if I look at some of your peers, whether the commentary that's coming in from Bajaj Finance or even in HDB or even Chola, which is, one of those companies that has been the leader in the last few years. They said, one of the comments that they made was, this year is a year of collections, not of disbursements. That's giving you some sense of the industry. What is your right to win? Because some of those shareholders in the unlisted market bought the stock at a much higher price. So there will constantly be that concern on that front. So return ratios and your right to win.
So if you look at our offering, it's a mix of primary and offer for sale.
Yes.
With the primary offering, our cap ad, which is will go up to over 22%. Our leverage will come down to below 5%. As far as returns are concerned, I think you need to give the organization another 1.5 to 2 years to fully utilize this money so that the return ratios keep getting better. I feel when you talk about the credit quality and such issues, we've been pretty quick on responding whenever there were challenges. In fact, when we saw challenges in certain segments, we became tighter and more conservative. And that was reflected in terms of our growth in those areas also. As I mentioned just some time back, we feel the worst of credit cost is behind us.
Okay.
And we should start seeing only better things. The reason also is because the market also has become far more responsible, both on the retail unsecured side. The other side which faced a problem was microfinance, and MFIN brought in a lot of regulations. So those things, I believe, have made the market more stable.
Okay. So, talking about capital support, like Prashant mentioned, because less than half of the issue is a fresh issue, the rest is in OFS. How well capitalized will you be? Will there be the need to look at any further equity capital support from the parent? Just a bit on the capital structure going forward after the IPO.
We've always had tremendous support
from your parent, absolutely.
Both our Tata Sons chairman, Mr. Chandrasekharan, and Saurabh have been extremely supportive. As far as this money which we are raising at this point of time is concerned, this should allow us to grow along with our own profits for the next 2.5 to 3 years. And post that, we may be in the market again to raise money.
Okay. 2.5-3 years. Okay. And any sense of, I mean, you're saying that, so obviously you see a lot of growth in the future, but what would be the capital requirement if the growth expectations are met? And you say you've been growing at about 25% anyway, ex of the Tata Motors Finance business.
If you look at it, the market right now, we are raising about 6,846 crores.
Correct.
Plus, there will be internal accruals through profits coming in. I think a combination of this, we do believe, will be sufficient for us to give us a growth rate, which should last us for the next 2.5 years. We can't talk about the future growth rates, but if you look at the past few years, we've been growing at 25% plus.
Rajiv, on a lighter note, not a lighter note, it's a serious question, but maybe prefacing with a lighter comment. You, by the way, missed you at the Banking Financial Services Summit this year. I had you on the NBFC panel, I think it was last year, the year before that. This year we had an interesting gathering, and I was just saying that banks are like airlines, right? I mean, they carry heavy loads, regulated, strictly on schedule, etc. Fintechs are like, ride-sharing platforms, sleek, sophisticated, kind of sexy. I mean, if you go there. And NBFCs are like railways. I mean, they take a load of people and go where others don't want to go. So there'll always be NBFCs which do well through cycles, and we've had a few of them. But in terms of the ability of what banks can do now and what NBFCs are able to do, allowed to do, you just saw, right? I mean, RBI's measures, nothing on the monetary policy side, but lots of regulations, really unshackling banks and allowing them to really do a lot more. Is that going to be an issue? Not an issue, but banks are big competitor in that sense. In many areas which so far were largely sort of served by NBFCs.
So that's always been true, Prashant. In the Indian market, competition is given. Whenever you find a segment which is profitable, there'll be 10 more companies wanting to jump into that. Luckily for us, this is a more regulated market, and things are more sane here. If you look at the whole set of banks, you will realize that there are top banks and then there are another set of banks. Even if you take the top private banks and when you look at us in size, we'll be in the top 6 or 7. Similarly, there are NBFCs which are at the top, and there are other NBFCs. So if you talk about us, what we are seeing is because of the trust which we enjoy, the credit rating which we enjoy, we do get the benefit of one of the lowest cost of funds in the market. And the ability to then target the best customers is possible for us, which again leads to that whole virtuous cycle of getting a lower credit cost, and then again getting a lower cost of funds. So I feel this market will remain competitive. We will all have to figure out our own niches to play in. And the good part, what we are seeing in India is it's huge. We continue to expand and we continue to see opportunities. Mm-hmm. So that's the plus point, and the growth is visible in all markets.
Which brings me back to the same point. I have to ask you this. Yeah. On growth, I don't think the market has any issue. On the pedigree, absolutely no issue whatsoever. The only bugbear has been margins. But you've said that if things remain stable, you may want to build on the unsecured book as well. So your margins have been between 5.2, 5.3% largely. Is there an aspiration to start going towards 6, maybe 7, and inching towards high single digits at some point?
So if you look at NIM plus other income, we are just above 6, around 6.1%. And clearly, in terms of what returns come in, one benefit does happen from margins, as I mentioned, that we are adding more of high NIM products, which should give us better things. The other benefit which accrues to entities like us is cost to assets. Because of the significant benefit which we are seeing on account of digital and now Gen AI, we do believe that there will be a step change in cost to average assets over the next few years. Just to give you a sense, our housing company in March 23 had a cost to income of 40%. In the quarter which just went by, it was 31%. because of the huge impact of digitization and our investment there and GenAI, you will start seeing a big plus also coming in from cost to average assets.
Okay.
Well, Rajiv, we'll leave it there. Thank you very much. I hope this is the first of many discussions as you start your listed journey. Good luck for the IPO.
Thank you so much.
Thank you very much. Well, I think we're going to take a quick commercial break here. We'll come back in just a bit from now and chat with the management of PNB. It's financials and focus second quarter business update from PNB. So a chat coming up with Mr. Ashok Chandra in just a bit.
Welcome back. You're tuned in to Corporate Radar. Well, the next guest on our show is Ashok Chandra, the MD and CEO at PNB, who joins us on the show. Hi, Mr. Chandra. Good morning, and thanks a lot for joining in. Just coming to you in a bit. First, we'll just lay out the big focal points that we're looking at. Loan book growth to outpace guidance. Is that a possibility? The corporate loan book is showing some signs of revival, and also support from Treasury book to be visible in Q2 or not. That's something that we'll try to gauge. Mr. Chandra, thanks a lot for joining in, sir. Pretty impressive update is what you're put out there. So let's revise a couple of numbers. What's the guidance with regard to the loan book growth? Point number one. And if you could tell us, it's going to be led by retail. And are you seeing signs of green shoots in the corporate book as well? Give us an outlook on that front.
Yeah, good morning. See, I will not be able to talk about the Q2 numbers, whatever we have disclosed on the SEBI. I think it is already known. Let us wait for the final audit to come and then we will disclose all those numbers. But yes, the guidance which we have given in this financial year, that is credit guidance we have given 11 to 12%. I think definitely for the full year, I think we will be sticking to that guidance and there will be some good momentum will happen. Deposit guidance, which we have given 9 to 10%, and already we have shown a good growth in the deposit, and we have already indicated what is the deposit growth that this quarter it has happened YOY, and it is more than 10.5%. I think the full year, the guidance which we have given 9 to 10%, definitely we are going to achieve those guidance. So I'm very much confident that the Q1 and Q2 put together and the full year, whatever guidance for the full financial year which we have given in the beginning of this financial year, I think definitely we will be going to achieve those numbers.
Mr. Chandra, we just had Tata Capital Management with us, morning Prashant here, and they're saying bumper third quarter, fourth quarter on the back of this GST cuts, especially consumer finance segments, SMEs, etc. Of course, I mean, for you, the book is much, much larger, but could do you echo that?
Yeah, I fully agree with that. And in fact, if you remember my discussion on the GST implementation on 22nd also, and when the GST rate cut had happened, on that day also I had interacted with all of you. And I had indicated that it is a landmark movement that has happened in the GST space, the simplification and the rate cut which has happened. I think that is going to bring a lot of momentum in the credit portfolio in the various segment. And see, this is not the short-term effect. We need to look for the long-term impact of this GST rate cut. And I'm very bullish about the credit offtake, which is going to happen in the retail, agri, and MSME, because the GST rate cut has impacted all those segments. And second important factor is that many of the items which a household daily uses, the rate has been made zero now. So definitely the purchasing power capacity of the individual is also going to increase. And this impact has been to every citizen in the country now. So definitely that impact is going to happen. And we are seeing those impact in the retail, MSME and agri, all these sectors put together. In the 10-15 days span itself, good momentum has happened. And going forward, I think definitely there will be good uptick will happen in this entire portfolio.
Mr. Chandra, great to have you with us on the show this morning, sir. So retail, agri and MSME, I mean, these have been growing very well in the past as well. Your first quarter performance was very good across these segments. My question is now on corporate. especially in light of what the RBI did in the last policy, right? I mean, pretty historic steps. They've made it easier to lend to large corporates, removed some of those earlier 2016 restrictions. They have allowed banks to get into M&A financing in a bigger way as well. So what is your sense? Do you see any signs of pickup in corporate credit? And my question is really that the RBI is enabling banks to lend more to corporates. But there has to be on-ground demand. Just, loosening the framework won't help. Your thoughts on this?
I think RBI has done whatever is required to be done. And for the last 7-8 months, a lot of facility it has been given to the banks to go for the project funding and the infra funding and all. A lot of things have happened. And if I can talk about our bank itself, I had indicated last time also that we had a pool of 1,38,000 crore sanctioned book for the corporate. And this has further gone up now in this Q1 and Q2 put together. I'm very confident that the sanctions which has happened in the last year and this year put together, the size is very, very high. And my request to the corporates now, they should come forward and they should avail the facility. I think it is not, there is a dearth of proposals. Proposals are there. And that is the reason we have the good sanction book. Only thing is that the disbursements are taking time. To some extent, see, a lot of project funding we have done, project financing we have done. And there, that it takes 1 to 2 years to take the full disbursement. That is one of the reasons why you are not able to see the impact immediately now. I think definitely in a span of 1 to 1.5 years, you will see the good impact happening on the project funding. And PNB is one of the largest banks in the country.
Yeah, so absolutely. I mean, your words are very encouraging. So overall, you are expecting your book to grow 11-12%. If I were to ask for some sort of a reference guidance for the corporate book particularly, the growth this year would be what? I mean, mid-single digits. Can it touch double digits? If not this year, at least as we get into next year?
We are very hopeful, and the book size which we have, which is the sanctions pipeline and the proposals in hand, all put together, I am very bullish that definitely in the end of the financial year, definitely we should be in a position to touch double-digit growth in the corporate loan book also. I'm very bullish about it.
All right, Mr. Chandra, a few other factors. When you join us, post your numbers again, we'll push you for some more numbers. But a few factors, PNB Housing Finance, that appointment, the new MD at the helm. When do we expect that, sir? The names are submitted, I believe. But when do we hear about that big announcement?
See, PNB Housing Finance Board they and the NRC, they are already running the process. I think you are all aware that advertisement was there and they had sought for the names and final selections are going on now. I think we are expecting that maybe by end of this month, I think definitely the board and the NRC should come out with the name now.
Okay, all right. So that's out of the way. We'll wait by the end of this month. So we've got a timeline at least. The other one is in terms of consolidation of PSU banks. Have you heard any directive that's coming from the center? Because that buzz again has come about. Even today I was reading a couple of papers and we as well have been reporting it, that there could possibly be some kind of more consolidation in the PSU banking names. You've heard something?
I think let us wait and see what it comes out. As far as I'm concerned, I'm not fully aware about this news item and this consolidation piece. So let us wait and see how the government proposes and the DFS and the RBI, how it comes out.
All right, we'll wait by for that. And finally, the Canara HSBC Life Insurance, out there, that IPO, I think the date has been announced. I think you all have close to, PNB has around 23% stake in that entity. So you'll be offloading some stake. If you would give us rough clarity on what is the money you'll be getting from this and what is the quantum you'll be selling in the IPO?
Yeah, we have 23% holding in Canara HSBC Life and 10% we are going to dilute in that and the price band and the valuation all put together. I'm expecting in the range of around 900 crore we should get out of this, the selling now.
Okay. All right, Mr. Chandra, always a pleasure, sir, speaking to you. Wishing you all the best. You're sounding very optimistic about the core business. And you've given us some guidance with regard to PNB Housing Finance, consolidation, as well as the stake you'll be selling in the next IPO of Canara and HSBC. Wishing you a good day ahead, sir.
Thank you.
And looking forward to speaking to you soon. Well, we have got the markets to look back at. And gradually, we saw an intraday dip, but on the Nifty, that dip has got bought into, and the Nifty Bank is holding its ground. It's gradually moving towards that 100 DMA, while the Nifty has moved towards that 20 DMA mark as well. The Nifty Bank actually has taken out the 100 DMA, so now it's trading above most technical levels. Vinay Rajani joins us on the show. Vinay, what do? Take money off the table, or do you say that this market is looking good for more? You'll want to trail your stop loss now on the upside.
Yeah, good morning and thanks for having me on the show. So it looks like that one should continue to do the trading in the on the long side in the sectors which have been doing good. As we have been discussing, the financials and Bank Nifty have been performing well. In fact, Bank Nifty has taken out its previous swing high well. If we see the Nifty is way above, below that the previous swing high. So definitely the sector rotation is going on. Some sectors are showing great amount of strength. So financials and banking is the space where we can see strength building in, and some more gains can be expected from here as well. So yes, overall we are bullish on the stocks and sectors. And definitely Nifty is having a strong resistance at 25,020. It is not showing any momentum. But even if we have the Nifty as a long position, then we would suggest a stop loss at 24,880 in the spot, and we can expect it to go up to 25,020 odd levels in the immediate term. But Bank Nifty definitely looks better than Nifty, and one can trade long in the financial stocks.
Okay, Vinay, morning. What about individual names? What would you focus on?
Yeah, so in the private sector banks, City Union Bank is looking good to us. So around 219 one can go long. 215 should be the trading stop loss. On the upside, we can expect a short-term target at 226. The second pick we'll take from the financials, that is Bajaj Finserv. So after showing some running correction today, Bajaj Finserv has resumed its uptrend. So not only Bajaj Finserv, if you see Poonawalla, Bajaj Finserv, Finance, Shriram Finance, all these stocks from this particular space after RBI policy announcement, they have been doing good. And I think Bajaj Finserv is one of the stocks one can look at for the long trade. So around 2030 can go long. 2000 should be the trading stop loss. On the upside, we can expect a target of 2090.
Okay, all right, Vinay, we'll leave it there. Thank you very much for joining us. Those are individual trades coming through. Well, we're going to focus on Bajaj Finance once again. Gaurav is here with that update that the company put out. Gaurav, take it away.
Well, yes, when we look at Bajaj Finance, a strong update is what we are seeing from the company. Around 23.6% growth on a year-on-year basis in terms of AUM. And at the same time, let's not forget that management had also guided the growth to be in the range of 23 to 24%. So it definitely seems that they're actually achieving this number. And in fact, they are achieving this number at the upper end of the guidance. Apart from that, when we look at the customer base now, that has increased almost by 20%. Now the total customer base stands at around 111 million. And at the same time, they have also added new customers. Around 12.2 million new customers have been added in this quarter itself, which shows 26% growth on a year-on-year basis. Let's not forget this stock is also in focus because of all the GST reforms, and given that they have a majority of their portfolio in the retail. At the same time, when we talk about Bajaj Housing Finance, there also we saw a good set of numbers, around 32% growth in disbursements. AUM grew almost by 24%. So definitely both these companies doing well. In fact, when we look at Bajaj Finance, the stock is up more than 3% given that the numbers are strong. So definitely watching out of this counter, specifically because of the strong numbers. So let's see how they are also delivering their ROAs in their results going ahead.
Okay, all right. Thanks a lot for that, Gaurav. For the time being, we slip into a short break. On the other side, Manisha Gupta is waiting. She'll tell us what's going on in the commodity space.
Okay, welcome back. We've got commodities in focus as promised. Markets up about 60 odd points, much better than the opening that we got at 9:15. Manisha is here with what she's tracking and what top of mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm looking at precious metals as a whole because another day, another month, and we're looking at new all-time highs coming in for many of these commodities here. Well, I'll start with gold, and we're looking at all-time highs in the international markets, all-time highs in the Indian space as well. And with this, we have crossed $39.20 an ounce for the global markets in sense of gold there, and we are trading nearly 50% higher for this year. Now, if you look at the last couple of years, gold is almost doubled now in that sense in prices. Well, it has to be about a prolonged U.S. government shutdown, which seems to be impacting the markets right now. And then it has been about the U.S. Federal Reserve officials. Various speeches are slated starting today itself. And Thursday, you have Powell testimony as well coming in. And that is where the markets will take further direction from. If you look at the all-time highs in sense of gold, the first half of this year saw all-time highs being hit 26 times. In the month of September alone, we've seen that happen 13 times. And today, 6th of October, we've seen gold prices hit all-time highs 3 times already. So gold clearly on a run there. But it's not just about gold. Take a look at silver as well. And we are trading above $48 an ounce. 67% of gains coming in for silver as well. And markets have seen 7 consecutive gains in sense of weekly gains there. Also, silver is approaching $49.50 an ounce. This has been an all-time high. We've seen that happen twice already in 1980 and 2011, and it's happening again in 2025. Markets at this point in time is pricing in near 100% probability of yet another U.S. rate cut for the month of October. And that really seems to be supporting gold and silver and then platinum as well, which has broken out of its 17-year consolidation. And we are looking at 12.5-year highs coming in for platinum there. And platinum clearly seems to be outperforming with nearly 82% gains in this year, with expectation that a third year of deficit in 2025 could be taking prices higher, and we could be looking at premium continuing into this space. Finally, I also want to talk about Bitcoin because we're looking at all-time highs into this one as well. $125,000 for a Bitcoin is where we are trading. 33% of gains in this year, and Bitcoin is up nearly 99% if you look at the last 12 months there. Well, clearly it has been about the U.S. government shutdown. That has been supportive. There has been this buoyancy that we've seen in gold and Bitcoin for most of this year, with an expectation that you could be looking at an outperformance coming in from Bitcoin for the last quarter as well. If you look at the spot ETF inflows, well, they have been quite high, the second highest since ETF was launched in Jan 2024. The weakness in US dollar, all of those factors continuing to support as well. So markets are looking at further gains coming in for precious metals and cryptos.
All right, Manisha, thank you very much for that. Poonawalla FinCorp up 8%, and that's the second quarter update, which I think has been put out this morning. It's a big, sharp. AUMs are up some 68% on a year-on-year basis, and about 15.5% on a quarter-on-quarter basis. AUM at close to about just under 48,000 crores. So very fast growth coming through from Poonawalla. And I think it's kind of technically also broken out after many months of consolidation, the Poonawalla FinCorp stock. We take a quick commercial break here. We're going to come back with our special segment, Indianomics. Lata in conversation with 2 former deputy RBI governors, H.R. Khan and S.S. Mundra. And they'll be joined by Suresh Ganpati of Macquarie Capital. And we'll discuss the new banking dispensation post October 1st policy. Stay tuned, coming up.